September 17, 2025, the U.S. Securities and Exchange Commission (SEC) formally approved generic listing standards for commodity-based trust shares. This isn't a routine technical tweak, it's a milestone policy shift. It signals that approvals for spot crypto ETFs will move from lengthy, case-by-case reviews to a standardized, higher-efficiency fast lane. A new, far-reaching market paradigm is taking shape. To grasp the depth of this change, we need to recall the old approval process. Under the previous framework, a spot crypto ETF had to clear two gates. First, the exchange's Form 19b4 proposed rule change. This was the substantive market entry decision and could be denied. Only then came the issuer's S1 registration, which focused more on products practices. The process was not only long, but highly uncertain. The spot Bitcoin ETF listing, for example, involved a 30-month tug-of-war, with the 19b4 step as the key bottleneck. The new generic listing standards fundamentally alter this. They specify that if the ETF's underlying asset meets certain conditions, it can be exempt from the 19b4 step and proceed directly to S1 registration. The most critical pathway is this. Futures on the underlying asset have traded continuously for at least 6 months on a designated contract market, such as CME or coin-based derivatives. Behind this is a major shift in the SEC's regulatory philosophy, from deciding whether to allow specific products to establishing uniform rules for how to enter the market. Part of the approval burden effectively moves to the CFTC and the DCMs, boosting both efficiency and certainty of listings. Within this framework, the first beneficiaries are already coming into focus. According to SoSoValue, 35 spot crypto ETFs covering 13 different tokens are currently in the queue. Among these, 10 major crypto assets already have futures trading stably for more than 6 months on coin-based derivatives, fully satisfying the exemption criteria. The 10 are Solana, XRP, Dogecoin, Cardano, Polkadot, Chainlink, AVAX, Hedera HBAR, Bitcoin Cash, and Litecoin. As a result, nearly 30 spot ETFs tied to these assets are expected to be first in line for swift approval. Crucially, this structural breakthrough arrives at a pivotal macro moment. The Federal Reserve has kicked off a new rate cut cycle this week. The US dollar faces devaluation pressures, and global capital is searching for new anchors of value. Two forces are now resonating. On one side, crypto assets are gaining an unprecedented, standardized, compliant investment channel. On the other, ample dollar system liquidity is seeking new allocations. The combination of clearer rules and abundant liquidity could reshape global asset allocation and accelerate the convergence of TradFi and crypto. Against this backdrop, investors should build a multi-dimensional watch framework, focusing on 4 signals. First, ETF issuance progress. Track S1 updates from eligible issuers. When key terms like fees and custodians are finalized, listing is usually near. Second, macro rate path. The Fed's dot plot and forward guidance are core to global risk appetite and directly affect pricing across asset classes. Third, cross-asset correlations. In a weak dollar phase, analyze how crypto moves in relation to gold and commodities. Look for linkages and rotations. And finally, ETF inflow data. As SoSoValue's tracking of existing Bitcoin and Ethereum ETFs shows, daily net inflows or outflows often lead short-term price action, revealing institutional behavior and real market sentiment. In sum, the rollout of generic listing standards and the onset of a global easing cycle have opened a double gate of policy and liquidity for crypto. This isn't just about a wave of new products, it's about crypto assets being pulled more rapidly into the mainstream global allocation map. For all market participants, understanding and adapting to this structural shift will be the central task in the period ahead.